There we are. There's the man.
George, what's going on, sir?
Good. How are you, man?
Good, very good.
Yeah. So I'm really excited to talk about this because I think a lot of people, they're not really up to date with this kind of stuff, and I feel like it's my obligation and duty to make sure everybody is, uh, you know, on top of this, especially if multifamily is part of their investing strategy. So with me today is Kenny Rijhwani. He is a mortgage agent who works in both the residential and multifamily mortgage space, and he kind of specializes in helping investors find capital for their projects. Not to mention you're a CMHC, the right correspondent, which may or may not be changing regarding this. Um, but what that means is that you have, you've done quite a few CMHC files.
Yes, sir.
Yes, sir. Okay. And there's going to be quite a few changes. Do you want to just quickly list off what a couple of these changes really quickly are?
Sure. So, thanks. First of all, thanks, George, for having me here. It's a pleasure being on your podcast, and I guess you're live. So yeah, as you said, we are a CMHC direct correspondent. We help investors, anywhere from residential to commercial, and now, as part of that CMHC direct correspondent status, we've been helping more and more clients get that CMHC financing. So June 3rd was when we heard about these changes, and they were officially announced on June 4th. So CMHC came out with a list of 6 items that they are updating in terms of how they do these multifamily loans. CMHC is a federally it's a federal body that insures these mortgages, and they're constantly assessing the risk in the marketplace, assessing the risk around economy, around affordable housing. And with that, every quarter, they're essentially changing some rules and some guidelines around this. So as of June 3rd, they came out with these 6 changes that I think they're mostly positive. It is actually a good change for investors. Some minor changes that may not be as favorable, but it's a good balance, and um, I feel like it's net positive for all investors. So in terms of changes, they made some changes to the MLI scoring criteria. I actually have a list right here. There's changes to the MLI scoring criteria. There's an update to the refinance criteria and what you can do with those funds. Um, Third is how they classify new construction projects. And then they also have a change to the amortization schedule on new construction. Use of lender correspondence, what you just alluded to a few seconds ago. So how that changes financing, and then some measures around how they look at contaminated sites when it comes to new
Huh.
construction. Okay,
There's quite a a big list of changes.
it's
Um,
it's yeah, it's a mouthful.
uh, for guys who maybe aren't as familiar with the multifamily space, so CMHC, they play a role. So most people know of CMHC when they're buying a residential property for a primary residence, less than 20% down. CMHC is involved in that, but they're actually involved in the multifamily side of things to insure products there as well. And with them, you get better amortization, reduced down, lower DCR, better interest rates, all that stuff that's associated with, pretty much everybody wants to get it, right, for their multifamily products.
Of course.
So these changes really, really matter. I'm gonna start off with the first one. I think this is the one that's I think ringing a lot of alarm bells for quite a few people, and that is the changes to the CMHC MLI-Select scoring, specifically the changes to was it energy efficiency?
Yep,
Can you tell me a little bit more of that?
that's correct. So CMHC's primary goal has always been to provide more affordable housing for Canadians. And as a result, they give you these incentivized loan programs where, as an investor, as a borrower, you're able to create that kind of housing and then, house thousands and thousands of Canadians. And as a result, they're always assessing the risk around, what's going on with the economy, what's going on um, with their mandate. Is it actually being accomplished? Um, how much loan funding they're doing and where that money is actually going and how it's being utilized. So every quarter they do their analysis, and then as part of this cycle of analysis, they've realized that. So as part of MLI Select, with MLI Select, you can get financing based on three pillars of these social outcomes. One being energy efficiency, second is affordability, and the third being accessibility. So you have to provide accessible units. What most investors were doing in like the bigger metro areas, like your GTAs and GBAs and all major towns, most investors were qualifying for these, the full points for MLI-Select using the energy efficiency. So most buildings around these areas are slightly older, so they may have an older boiler system, older windows, outdated lighting. So there is a whole list of things you can do to get your building to be at a certain level of energy efficiency. And with that, you score these 100 points and you get the full MLI-Select program. So in these bigger towns, that's what most investors are doing. In towns, in provinces like in the prairies, Alberta, for example, it makes sense to have certain units at an affordable rental rate because the average income there is much higher. So getting those units at an affordable rate is just more viable, and most people are scoring points like that. So as part of the review, CMHC realized that the whole energy efficiency criteria has been overutilized and almost abused in a way. So they're seeing that most investors are doing that, but they're not actually providing affordable housing. So what they came back by saying, you know what, it's great that you're doing these energy efficiency updates, but at the same time, we need some affordable housing. So as part of that change, where you can achieve a full 100 points from energy efficiency, now you can only get a maximum of 50 points, and you have to mix that in with either energy with affordability or accessibility updates, right? So that impacts some borrowers. Sorry, you had a question?
Yeah, I guess my concerns are who does this affect? Because let's say I'm somebody who bought a multifamily property. I just closed with interim financing, and my plan was to do the necessary work to get the energy efficiency work done, meet the requirements that the CMHC has set, and then refinance out with MLI-Select. With the Lamborghini, everyone talks about it. We get our what is a 50-year amortization, 95% loan value, all that stuff, right? What do I do if what do I do now if I'm not a person?
And so if you're an investor in that situation, you pretty much have to go back to your spreadsheet, kind of
Okay.
redo your numbers. So unless your application was submitted prior to June 4th,
Okay.
you're still in the older guidelines. But if you have that bridge that interim financing that you have right now, but your CMHC application hasn't been submitted yet, and that happens after June 4th, you unfortunately fall in that new set of guidelines. Okay.
And I know this is quite new, what do you find people who are stuck in that situation, what are they pivoting to for the most part?
So two things. So one, you go back to the spreadsheets, you kind of reanalyze your numbers. Now, where you would have achieved a full 100 points and you get qualified for up to 95% loan to value and up to 50-year amortization, now you would only get a max of 85% and 40-year amortization. Okay. Now, there's two things to it. One, getting 95% loan to value and that 50-year amortization. The 50-year amortization, the 95% loan to value is viable in most cases, but the 50-year AM is dependent on the remaining economic life of the building,
Yeah.
right? So as part of the building assessment, as part of the appraisal, we also look at how long that building is good for. So if your building is only good for, if your remaining economic life is only 45 years, you're likely only getting a 40-year amortization. So most clients don't achieve that full 50-year amortization just because of the age of the buildings.
Gotcha.
Right? So most people are not achieving that 50-year amortization anyways. Now, it does impact your overall loan to value that you cap at 85%. Now, you go back to your spreadsheet and look at, okay, does that 85% loan to value, is that actually good in a way because you're actually using less leverage, so that actually makes your bottom line, your cash flow better, right? So that may be a positive way of looking at it. And the second thing would be, now if you have to mix it with an affordability pillar or the accessibility pillar, now to make your building accessible, it is quite a bit of work. But let's say if you're trying to get your building to be at that affordable standard, so where you have to put your rent below the 30% of the median income, lowering your revenue, how does that impact your financing? And then how does that impact your cash flow, right? So you might actually be better off going for that 85% loan to value with the 50 points and up to a 40-year amortization, right? Versus actually lowering the rents or putting in other effort to make your building more accessible. So it's kind of every investor's got. I mean, it's a brand new change, so investors are kind of reevaluating their numbers. But this is the new rule. I mean, you have to kind of go by that. So in terms of energy efficiency, you can get more points. So either you lower the rents for a certain number of units, or kind of just go with the 85% loan to value.
What about the people who were aiming? Because I think the entire structure of energy efficiency got scaled down. So what used to be 50 points is now 25.
So
So what about the people? Is that true or no?
that is
Yeah.
true. Yeah. So the scale. So that's where the 100 points became
Yeah.
50. The
So
first. I think the first tier. Give me 1 second. I have it right
because
here.
what I'm thinking is, what about the people who were planning to do 50-50 mix to begin with? Now they have to do even
Now
more of something
they
else,
can
right?
boost up a little bit more on the energy efficiency side of
Yeah.
things, right? So
Okay. So
definitely a slight challenge. That is not the most pleasant of the updates out of these six
no.
things. Yeah,
So I bet you're probably getting quite a few people maybe contacting you a little bit worried these days, right?
of course, of course. But CMHC changes certain rules. I mean, 3 months or 6 months ago, they made some changes to what you can do with the use of funds. That was a major thing. They changed how, what kind of debt can transition into CMHC. That was a major thing. But there, with every not so good news, there are also some good news. So
Yeah,
and you're dealing with the federal government, so there's always changes expected, right?
exactly. Okay, moving on to the next one. So you mentioned that there's some changes regarding what you can do with the funds when you refinance. Because if I remember clearly, CMA said before they said if whenever you refinance, you took the money out, you're supposed to put that money into that property or another multifamily
So
property.
hold that thought, George. I think we should. So I find that is like one of the best news that came out of this. So let's leave it till the last.
Okay, okay,
Let's leave it till the
okay.
last. Let's cover a couple other slightly boring changes.
Boring
Uh,
changes.
yeah. So the reason I say boring is it does not impact the majority of the pool of investors. So these ones are geared more towards new housing construction
Okay.
and the CMHC
So
insured loans for new housing.
how about the changes in terms of the changes in amortization for new construction and also what they define is new construction has changed. Can you
Sure.
tell me about
So, all right. So let's talk about the changes to the amortization. Okay. For new construction projects, on their standard product side. So CMHC has two of these major loan programs. The standard. So it's called the MLI Standard, and then the MLI Select.
that?
Right. So the standard was always the product that CMHC had, and they introduced MLI Select about 2 years ago. So what differs MLI Standard to Select is in Standard, you get a maximum of 85% loan to value, and you get a maximum of 40 years of amortization, right? On the MLI Select, you get up to 95% loan to value and a maximum of 50-year amortization. So the big difference here is what they're saying for new construction when you refinance into your longer term debt. If you're qualified for that standard loan, so when you start new construction, you get a CMHC construction loan, for example, your exit is already planned because CMHC sort of has to run numbers from the beginning to what your exit will look like. So say you were approved under the standard program, you are now eligible to get 50 years of amortization versus 40 years, which is great
Oh,
news, right? Because you would have expected to get a 40-year AM, but now you're qualified to get 50-year AM, and it's a brand new building, so your economic life supports that.
okay, that makes a lot of sense. So that would with a longer amortization means lower payments, and then with your DCR means now you can take out more money. It's that's amazing.
That's a win.
That's a great change.
Yeah,
That's
that's a
a great
win,
win.
right? So again, this is only for new construction projects. So I see that as a big win, right? Um, and you would have been approved for that standard product to begin with. So the other slight change, the other slight difference between the standard and the MLI product is with your standard products, you have to hit a slightly higher DCR. So you're looking at 1.2 to 1.3, where on the MLI-Select is 1.1. So you would have qualified for that 1.2 or 1.3 DCR anyways, but now you're just taking advantage of a 50-year amortization.
So for some people that couldn't hit 1.2 or 1.3 before, now with the 50-year AM, now they can,
You
right?
will be able to, exactly.
Yeah, amazing.
Exactly, right?
Okay.
So
What about the difference
that's a
in
positive change.
what about the difference in what they consider, like what they that define as new construction? What's changed? Is that for the good or for the
So
bad?
it's also for the good. So for the most part, it hasn't changed much. So what CMHC considers a new construction is if you're doing a ground up construction where there was no existing structure, or the structure that was there has been completely demolished, or it was damaged due to fire or other natural causes, and you're doing ground up construction there. Another thing they consider as new, and this is all existing. Another thing they consider a new construction is if you're converting a non-residential space into residential space. So, for example, a warehouse, an office building, and you're converting that into apartments, where you're doing major changes to the structure of the building. So CMHC has always considered that as a new construction. Now, with this new change, what they've done is they've also included any buildings that have been vacant for more than 12 months, right? And if you buy a building it's vacant for more than 12 months, it happens rarely, but I'm sure there are buildings out there that are going through a dispute, or a landlord was trying to sell it for over a year and they've vacated the whole building, but they haven't been able to sell it. Now, as a developer, you can actually go in, you can buy that building, do your rehab, and still be able to qualify for a CMHC construction loan. So,
Oh, that's really good. It's
so
like
that's yeah.
I can imagine some properties, some multifamily properties that need extensive upgrades when it comes to the main, the inside stuff. They have full electrical, plumbing, maybe some structural upgrades, maybe elevator upgrades, installing one. That stuff added together could easily just be a year, and you need vacant. Some of that work, I would imagine, nobody can live in the whole building while you're doing
Exactly.
it. So just
Exactly.
by coincidence, if your renovation time frame happened to exceed a year, then you now get all the perks that come with being considered new construction, right?
Of course. So that's, I mean, again, that's another small win for people that are getting into rehabbing buildings or developing new buildings. So again, it's another positive, right?
Okay, okay.
Yeah.
Okay, and then moving on to the next topic, and this is the one that I think I was the most unsure about, was the changes to funding for contaminated sites. Because I know can you let me know what the rule was before and what is it now? Because I think the context matters.
Sure. So maybe for context, let's talk about what contamination means, right? For these bigger buildings, when lenders look to fund these buildings, they want to get something called an environmental safety report. What that report entails is they actually do a study of the site, and they want to see if there's any
Oh.
sorry, I
Yeah,
lost
you were
my
talking
train
about
of
the
thought.
ESA,
So
the lenders. And
ESA, yeah. So they look at any kind of possible contamination that may be on the site, in the air around the building, the soil, the water that touches the site, and lenders want to make sure that there is no contaminants. And these contaminants could be hazardous waste, it could be oil, it could be gasoline, it could be just oil tanks buried under the soil. So as part of any development site, they have to make sure that the site is clean, and that's when they will fund the project. So what was happening before was CMHC would not touch a building if there's known contamination on the site. So if you've done your ESA as part of your permit process, and you discover yes there is some contamination, you do have to remediate that every time before you start any construction. But as part of the loan application, CMHC would not touch that until you've actually done the remediation, and then you apply for the COI, for the certificate of insurance. Okay.
okay,
Now, the good thing that's changing as of June 4th is CMHC is actually open to you submitting your application. So say you know that there's contamination on the site, but you have gone through that process of identifying that contamination, you can still apply for a certificate of insurance, and CMHC will entertain that. And this is again for a CMHC insured construction loan, so where you're applying for construction financing. So CMHC will still issue a certificate of insurance, knowing that you have a remediation plan, knowing that you're going to remediate that, and you have to remediate that site before your first draw or
Okay.
within 6 months of getting that certificate of insurance.
Okay.
Okay, so as you're doing your remediation, you can apply for your certificate of insurance. You know, that normally takes about 4 to 6 weeks. So you're not kind of wasting time. You're doing your remediation at the same time you're in the process to get your COI.
Okay. So I'm just trying to wrap my head around. So the practical for someone, let's say I wanted to buy a multifamily property, and we found out it's contaminated, but despite knowing the cost of remediating the contamination, I still think it's a good deal and I want to move forward. This just really allows me to shorten the time frame. Is that
Exactly.
what it changes, really?
Exactly.
Okay.
Yeah. It just, yeah, you're cutting down anywhere from 2 to 3 months in the whole application process. Yeah.
Oh, that's amazing.
That is
That's
amazing.
good.
Yeah, because I mean, for the remediation, there are multiple studies you have to get done. So your phase ones and phase twos and phase three. So sorry, that normally could take you anywhere from 2 to 4 to 5 months to get that site fully remediated. But if you have the ability to apply for that certificate of insurance, having all the paperwork, all the plans in place, that really cuts down up to 5 months of your construction time.
That's great, because I think, you know what, I think CMAC might be onto something where it realized that they want to encourage this level of construction, and they encourage investors to actually clean up sites, and instead of saying, oh, this isn't contaminated, not, CMHC is going to give me such a hard time, I'm not going to move forward with it because it costs too much money, because the holding cost is too long. With these changes, I think a lot more investors are going to be willing to jump into contaminated properties, and with the rewards on the other side.
Absolutely, man. I mean, CMHC, I mean, they are trying to promote more housing starts. The housing starts have been sluggish in the last year or so. So their absolute mandate is to encourage more and more new housing.
Absolutely. Okay, leaving the best for last. This is the one that you said is probably going to be probably the best thing that's
So
coming to this.
we have one more, the lender correspondence
Oh
status.
yes,
So I'll make that quick,
yes,
right?
yeah.
So
Let's talk
there's
about
one,
that real
yeah.
quick.
Okay, so as part of us being brokers that can submit CMHC deals, what CMHC allows certain brokers. So as part of a rigorous application process, CMHC awards something called a direct correspondence status. Now, just like a CMHC loan application, this is a CMHC application for brokers. So they basically want to look at, they do a deep dive into your CV, they look at your funding volumes, they look at your overall reputation, your quality of service. And with that, you go through this process of achieving this direct correspondence status. What this direct correspondence status allows us to do is, when you're applying for CMHC financing, if you're not a direct correspondent, you would go to a bank. The bank would do all the paperwork, and then they would be the one to take that application to through CMHC. As a direct correspondent, we can first go to CMHC, get that certificate of insurance, and then shop around with different lenders for better terms and pricing. So the biggest change that's coming right now is they're actually getting rid of that direct correspondent status as of September 3rd. So what they've noticed some inconsistencies across the board, and they want the bigger lenders to directly apply to CMHC and not having individual brokers do that. Now, this change not so great for clients, because I mean, they would think that their ability to shop for rates has gone down. But what I say to that is it actually makes it more important than ever for clients to work with mortgage brokers that have good relationships with lenders, who have done a ton of volume with them. They know them. They know their CMHC the underwriters. So at Finlay Mortgage Team, we've had that direct correspondent status for over a year, and at the same time, we've been funding CMHC mortgages before that. So our relationship with lenders, with different lending partners, have been phenomenal. We have direct access to their underwriters. We are able to get on the phone with them as soon as possible. So having a broker, with that ability actually is beneficial for the client, and working with a broker like that is beneficial because as a broker, we kind of understand what the lender policies are and what their guidelines are. So if we get a file and we know, what the loan limitations are, if it's a loan sub $1 million, sub $2 million, we know what lender to go to and which lender will provide us the better pricing and the better terms. And that actually is beneficial because that cuts down any kind of ambiguity around that, any kind of wasting of time, any kind of wasting of like just the general energy, because going through a CMHC approval process, it's very document heavy, it's very time consuming. So if we know as a broker what lender will definitely approve this deal at the best rates and best terms, it makes sense to work with a broker like that for the clients, right? So yes, that direct correspondence status is going away, but at the same time, as a borrower, as a client, look for a broker that specializes in doing CMHC financing, because that relationship will be huge.
Gotcha. And that someone would be you, right?
I would. It's a selfish plug, sir.
So I just wanted to clarify because I noticed there was some text, some mentioning about specifically approved lenders being a thing. And I think there was some, I don't know if this was part of this announcement, maybe announcement earlier in the week or something like that. It's something to do with how long you have to wait between like interim lending or things that aren't CMHC approved. Were there some changes associated with that? Because exiting out of like a VTB straight to CMHC, were there some changes about that as well?
Yes, sir. So that change has been our absolute best news ever. So that was the change to the refinance criteria with CMHC. So as part of their risk assessment last year or 6 months ago, they made this change where if you have acquired a building using private money to using BTB or a non-traditional lender, you can do all that, but in order for you to transition into CMHC, there's only a certain list of lenders. So they're called the NHA approved lenders, the National Housing Act approved lenders, and these include the big banks, the credit unions. So what CMHC said was you need to be with that, you got to bridge your debt with that lender and then transition to CMHC. So technically you cannot pay out a private investor, a BTB, or a non-NHA approved lender. You need to be with these lenders and then go to CMHC. And what you can do with those funds. So if you have an equity takeout, for example, you can only use those funds, one, to pay out that NHA approved lender. Second is to invest that money into another multifamily asset. And the third would be to do any major capital improvements to your current asset. So the use of funds was very restricted. So now, as part of this change, the biggest thing they've done is remove that 24-month restriction on when you can first refinance into CMHC. So what that means is now, let's say you've acquired a building, you gotta create a VTB on it, you raise some money from investors, and you're able to put some private debt on it. Once you've stabilized the building, you can go directly to CMHC. You don't have to wait. You don't have to bridge it to an NHA approved lender. So when you do this bridging, it is sort of like because it's an interim solution, the cost to borrow, you're looking at prime plus 2 kind of rates, and there's other fees involved in that. So that is an expensive debt to service. So now not having to do that and going directly from your private debt to CMHC, that reduces that whole friction, and paying that extra cost. And also you don't have to wait 24 months to go from this private debt to CMHC.
Okay.
So that's huge, right?
So let's say before this change, let's say I bought a building. I got I don't know, I got a VTB for, I don't know, 70% loan to value, and then I raised capital for the rest. Before I would do some value add to the property. I would then refinance with one of those approved CMHC approved lenders. Wait 24
And then
months.
wait 24 months. Yeah. So now you've stabilized the building using your private debt and renovation funds, and now you have to bridge it with an NHA approved lender, and now you got to wait for 2 years, and then you go to CMHC. Yeah. So now you're servicing this expensive debt for no
Okay.
reason.
So
Yeah,
now what the change is now I can just jump straight into CMHC without using a interim approved lender and also without waiting the 24 months.
exactly. Yeah. So that is just huge for investors, right? Because investors are burning a lot of money waiting for that 2 years. But now if you can go directly to CMHC, and the other thing with the use of funds is now, one, you're essentially able to pay out any private debt, any private investors, VTB. And if there is any surplus equity takeout, they don't dictate what you need to do with those use of funds. They don't actually mandate that you use those funds to do capital improvements to your building or invest in other assets. So if there is surplus money that you have, as an investor, I'm sure you will be looking for new projects and new opportunities to invest in, but CMHC does not directly mandate that anymore.
So if I wanted to just refinance my building and buy a yacht, the government can't tell me what to do anymore.
I don't hear that. Yeah, you can buy a Ferrari if you want. So that's huge. I mean, just the ability to pay out all the private debt, and of course, as an investor, you're not going to be buying Ferraris or yachts, but just having that flexibility to use that funds, to whatever need you have at the moment, that's huge,
Yeah.
right? So
Okay.
that's a huge win for investors.
So between all of these changes, there's about six total changes. Overall, would you say it's a net positive or net negative for investors out there?
Oh, net positive all day.
Net po
Yeah, it's net positive. Yeah, minor changes to the whole MLI Select program, which sure, a lot of clients are being impacted, but if you look at the grand scheme of things, it is net positive. I mean, better amortization, more ways to do your new construction, and then this biggest thing is the refinance criteria because a lot of investors do buy underperforming assets, so at some point they will be refinancing it. So this is huge. And sure, I mean, the energy efficiency criteria has changed a little bit, but I mean, that's just what your new underwriting will look like. We never had MLS Select 2 years ago.
Yeah.
So people were going for 85% 40-year AM. MLS Select it's been amazing. It's been beautiful. But at the same time, these changes they're expected with the government.
I mean, I'm not surprised. People were abusing the crap out of the energy efficiency, weren't they?
It is what it is, man. It's like, and that goes on the residential financing as well, right? Certain lenders have better underwriting guidelines if you're buying rental properties versus your own properties, right? So people take advantage of whatever guidelines are out there, and again, as brokers, it's our job to stay on top of what the changes are on the residential side, on the commercial side, and then guide clients accordingly, and just constantly educate them on how to best navigate their investments.
Would you say that this will overall net result in more affordable housing, more people choosing the affordability criteria for their, or will they just give up on MLI Select to begin with because now MLI Standard is actually pretty good?
MLS standard is pretty good. So I mean, MLS Select is still good because you still qualify at a DCR of 1.1, right, versus 1.2, 1.3 on the standard.
Mhm.
But it's still, I mean, you're still going to be making energy efficient buildings. In terms of affordability, it's still a challenge in like Ontario or Vancouver kind of provinces, or BC kind of provinces. It's just because you're keeping your rents at affordable rates just would not, you know, you won't make the cash flow, and second, your buildings won't even debt service because the price per door is so high. It's hard to debt service those buildings if you keep those units at affordable rents, right? So we're hoping some people go that affordable routes, but in terms of um, underwriting these buildings, when we look at affordability criteria, it severely impacts your debt service coverage. So I think people will stick to, they'll still take advantage of the MLI Select. They'll go with that 50 with the 50 points and 85% and 40 years. Um, would there be any other changes coming to this? I'm sure CMHC will be reviewing these, and maybe they reverse this policy, or maybe they up to 50 to 75 points in 3 months or 6 months. So who knows? CMHC has always been changing policies every 3 months. There's some change. So we're hoping something better comes out of it.
Yeah, exactly. And this is where it's so important to have someone who's in doing this day in, day out, someone like Kenny here who's, multifamily is your life, right?
Multifamily is all we do, man. Yeah, we've been heavily focusing on multifamily for the last 2 years, and I mean that's where the investors are going, and that's where we pride ourselves that we are offering that support and solution, and we're helping these multifamily investors grow.
Amazing.
Yes, sir.
All right. So that's really it for the multifamily changes here. If somebody wanted to reach out to you to inquire if their properties qualifies for Cmhc or what, because I know you're involved from beginning to end, from the intern, because if you're buying a multifamily that's not performing very well, you're gonna have to have multiple financing stages throughout from beginning to end. So where can they reach you and pick your brain and form a plan together?
Of course. So I'm mostly available through Instagram. My handle is Kenny Mortgages, and my website is kennymortgages.com. Reach out, book time for some call. If you have any buildings that you're looking at, I'll love to help you underwrite them and look at multiple options. Also, you can reach me at my phone number at 647-990-9000. But primarily on Instagram, let's connect. I post a lot of content there, and hopefully, you find that educational, and I'm able to help more clients.
I found you because of your content on Instagram a couple of years ago. So you do make some good stuff.
I appreciate you, man.
And if you guys are looking for multifamily properties down Eastern Ontario, I don't for multifamily. I don't really necessarily have a radius. Anywhere east of Oshawa, to be honest, I'm down for anything because I love multifamily as well, and I just think it's really cool. I just think it's fun. It's not about the money. I just think it's fun, and I think you probably think the same way. It's just something about it, right?
Yep.
And so if you're interested in doing some multifamily stuff on the east side of Ontario, definitely reach out. If you're watching this from a recorded live or anything, my Instagram handle is right there, Cashflow George. That's the best way to reach me. But yeah, thank you so much for joining me in this live and giving my audience this so important update on MLI, Cmhc and MLI, because I know there's a lot of people out there who they pay a lot of money. We're talking about 5 figures on coaching, and they tell them yes, MLI is good, and then that's all they got, and they get this thrown into the world, not knowing what the hell is going on, and they really need to see the reality of things. It's not all sunshine and rainbows, but the more information, the more facts you have, the better you are protected, and better you can make some money in your investments.
Of course, yeah. I mean, there's a lot of misinformation going around, and a lot of false expectations being set. But yeah, I mean, connect with realtors that live and breathe multifamily. I mean, investors and mortgage brokers, same thing, and you'll be in good hands.
All right, guys, that's it for us. We'll see you guys another time, I guess.
Yeah.
All right.
Thanks, George. All right. Talk to you.